use the two. They are completely different, and the results too are different. I'll start off with savings, where you keep your money in the bank, whether it's a check account, savings account, or a call account. So, what I can tell you from straight off the bat is that none of the banks are going to pay you an interest rate that is comparable to an investment. So, I mean, I've had a look at the top five banks and the range of interest rate that they pay per annum or per year. You're looking at your check account. Actually, you don't make any money on your check account because all you are paying is fees. So you deposit your money, and on a monthly basis they deducting fees and bank charges, etc. Once you move over to, let's say, a savings account, you are getting less than 2%, sometimes as low as 1% or even less than that. But let's say you're getting just below 2% on your so-called savings account. That is not a great return at all. If you're trying to build your investments or grow your money, let's put it that way. Because if you look at inflation, so obviously inflation, what one rand can afford now compared to what it was affording in the previous year. So it's currently at 7.4%, which means that for every rand, you're getting 7.4% less now, today, compared to last year or the previous term. So that is one thing that you need to keep in mind, that if you are keeping your money for a year with a savings account in a bank, and it's only paying you 1.5%, and then a year later, everything else that you could have bought, or for every rand that you had, you are now 7.4% less. So your rand has dropped by that much. So you are buying for less, 7.4%. So what do you then do? So one of the best things that one can do is you build up a savings, and in this case I'm saying savings because you want it as liquid as possible. So you would want to keep at least between 3 to 6 months in a savings account as an emergency fund. So if anything goes bad, you can always tap into and have that money immediately. But beyond that, you then need to look at something that grows above first of all, maybe the inflation rate, or as close to as inflation, so that you are maintaining your money's value. So the first one that I would recommend, and it's very conservative, obviously not high risk at all, it's the government retail savings bonds. The government, South African government, is selling these bonds. I think the minimum investment is 500 rand, and the return on that is 8.75% per annum, which is above inflation. So at least your money would be growing while invested. There's only one requirement, or one of the requirements that I need to mention, is that you need to keep to be invested for at least 3 years. You can withdraw prior to 3 years, but it would then affect the calculation of your 8.75 return that it guarantees. But if instead of keeping your money in a check account or a savings account, if you do have the luxury of 3+ years, the safest one would be the retail savings bonds. And then the next one that I recommend to a lot of people is that obviously not everyone is familiar with the stocks, which stocks or shares to buy in the JSE, which investments to make. So if you are looking for a vehicle that will give you good exposure to the JSE without you having to look at, is ShopRite better than Pick n Pay? Should I buy Woolies shares? What is happening with Woolies? What will affect their share price, etc. It is a product called ETFs, or exchange traded funds. So what these do is that they then buy a basket, let's say, of the top 40, and then they sell units or shares of that to um, to investors like you and myself. So you now don't have that worry of looking into individual shares and taking a bet to say, I think ShopRite's going to outperform Pick n Pay, and I'm putting all my money in ShopRite, or vice versa. Whereas this gives you the full exposure of, let's say, the top 40 or the industrial index, or whichever other um, indices that they follow. There's a few, and I mean, you can do some of the research yourselves online, but you then, whatever dividends are paid per individual, let's say there's 40 stocks in that basket, the shares that pay dividends out of that basket, you would also benefit from that without the headache of following each and every share, but you then follow one instrument, which is the actual ETF that you would invest in. And the returns are what the actual shares, the underlying shares, would be earning, and you would benefit from those units. And then obviously outside of exchange and ETFs and shares, obviously the others are your normal investments, where you invest in properties, where you buy, or you guys form a group of individuals, invest in a property as a group, register that, and earn rentals on that. So I guess, I mean, I can go a little bit deeper in the topic, but for now, those are the two main points I wanted to highlight, which is your saving versus investment, and what are you actually earning on those. For now, I would like to thank you guys for watching the video. If it's your first time around, please like and subscribe, and leave some comments, questions. I'm more than happy to answer. If I don't have the answers, I will look up some of the answers, or direct you to the correct platforms. Thank you very much. This is Bulls and Bears, Lincoln out.